Right. Today we're doing a deep dive, opening up this massive 10-part retail investor slide deck and a really detailed equity research report on Grab Holdings, ticker symbol GRABUB on the NASDAQ.
Fascinating company to unpack.
It really is. Our mission today is to tear this company down chronologically, figure out the actual mechanics of running a multi-country super app in Southeast Asia, and understand why they are sitting at this completely fascinating strategic pivot point right now.
But before we get into the plumbing of that super app, we definitely need to lay down the ground rules for the sandbox we're playing in today.
Always important.
Right. So we are reviewing independent retail investor analysis and equity research. This deep dive is strictly for educational and entertainment purposes for you, the listener.
Yep.
Neither of us are licensed financial advisors, and absolutely nothing we discuss here is financial advice. We're not recommending you buy, sell, or hold Grab or any other security. You always have to do your own due diligence.
They launched an app called MyTaxi, and they weren't just building an Uber clone, right? They were building a trust engine.
Yeah, and that fundamentally changes the architecture of a business. When your foundational layer is physical safety rather than just, pure software efficiency, you make different choices.
Right, because if it's just about efficiency.
Exactly. If your goal is just to connect a rider and a driver super fast, you build a certain kind of algorithm. Yeah. But if your goal is to make sure a passenger gets home safely in a market that's, quite frankly, plagued by unmetered or dangerous cabs, your early capital doesn't just go into code.
Where does it go?
It goes into verifying identities. It goes into working with local transport authorities. It forces you to build this deep, hyper-local infrastructure from day one. You have to understand the literal street-level reality of your market.
That makes total sense.
And that hyper-local, trust-based approach is the seed that eventually allowed them to evolve from a specialized taxi safety tool into this absolute behemoth.
I mean, we use the term behemoth, but if you're listening to this in North America or Europe, you probably don't have a direct equivalent to Grab on your phone.
No, the ecosystem is totally different here.
Right. It's what the industry calls a super app. To visualize it, imagine taking Uber, DoorDash, Instacart, FedEx, and your local neighborhood bank.
It's all mashed together.
Yeah, compressing all of them into a single green icon on your home screen. They do mobility, meaning ride-hailing. They do deliveries, so hot food, groceries, packages. And they operate digital financial services.
Across a massive footprint, too.
Oh, huge. Cambodia, Indonesia, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam. That is over 900 cities with vastly different regulatory regimes, languages, and currencies.
And tying all those disparate services together, it isn't just a gimmick, right? It is the core mathematical strategy of their business.
Okay, lay out the math for us.
Let's look at the financial breakdown from the research report to see how the pieces balance out. For fiscal year 2025, Grab pulled in $3.37 billion in total revenue.
Wow.
Over half of that, about 53%, or $1.8 billion, is deliveries. And that segment alone is compounding, growing 21% year over year.
That delivery number really jumped out at me in the deck because they aren't just acting as the middleman anymore. They are vertically integrating into the actual physical infrastructure of groceries.
Oh, yeah, the physical footprint.
They own physical retail chains now, like Jaya Grocer in Malaysia. It's a fascinating shift from just moving the tomatoes to actually owning the tomatoes.
Well, it gives them a massive margin advantage. When you control the inventory, the warehouse, and the last mile delivery network, you capture the economics at every single step of the value chain.
Right, you're not splitting it.
Exactly. Now, beneath deliveries, you have the mobility segment, which is their legacy ride-hailing business. That represents about 36% of revenue, pulling in $1.2 billion and growing at a solid 16% year over year.
Still chugging along.
But strategically, the most critical piece of this pie is financial services.
Yeah, the fintech side.
It only accounts for about 10% of total revenue right now, sitting at $347 million, but it is expanding at 37% year over year.
That financial services pivot is arguably the most important thing happening at the company, and we have a lot of ground to cover on how they are literally building a bank.
It's a huge shift.
But before we get to the banking, I want to zero in on the sheer scale of the user base. The report highlights this staggering metric from the first quarter of 2026. 51.6 million monthly transacting users, MTUs.
It's a massive number.
We aren't talking about app downloads or dormant registered accounts. That is over 50 million unique human beings actively spending money inside this ecosystem every single month. How do you keep a population the size of South Korea entirely locked into one app?
It comes down to a concept management refers to as their flywheel.
The famous tech flywheel.
You know it. In platform economics, a flywheel is a self-reinforcing loop where different parts of the business feed each other to lower costs and increase engagement. The core metric you're trying to manipulate here is CAC, customer acquisition cost.
Okay, let's break that math down for the listener. If I'm running a standalone food delivery app, I have to spend millions on Instagram ads, promo codes, billboards, whatever, just to convince you to download my app and order a pizza.
Exactly.
It's incredibly expensive to buy your attention in the first place.
Right. Your standalone delivery app might spend $50 in marketing just to acquire one user, hoping they order enough pizza over the next 2 years to pay back that $50.
Which is a big gamble.
Huge gamble. But Grab fundamentally alters that equation because you are already inside their app booking a ride to work. They don't have to spend a dime on external marketing to reach you.
Ah, because you're already there.
They simply push a notification offering a discount on groceries that will arrive exactly when your ride gets you home. You pay for it seamlessly using the digital wallet you already loaded for the ride. The cost to acquire you as a grocery customer is effectively zero.
The cross-selling potential is just wild. It creates a captive audience. But, this brings up a major point of friction for me when I look at this. If I am an investor looking at this deck and I see 50 million people whose daily lives, their commutes, their dinners, their payments are totally intertwined with this one app, I'm thinking about pricing power.
Right, the monopoly squeeze.
Exactly. If the switching costs are that high, why doesn't Grab just slowly turn the dial and jack up the prices? Just squeeze the margins.
It's a completely rational expectation for a dominant tech platform, but the equity research is very explicit here. Grab's pricing power is currently rated as moderate to weak.
Really?
Yeah. They do not operate like a monopoly that can arbitrarily dictate prices. They compete fiercely on affordability.
But that seems counterintuitive. I mean, if you have the flywheel, why are you still competing on price?
Because of the macroeconomic reality of their user base and their regional competitors. The report provides a perfect case study for this from Q1 2026.
What happened then?
There was a significant fuel crisis driven by geopolitical shocks in the Middle East. Fuel prices spiked across Southeast Asia. Now, a traditional monopoly would simply slap a massive fuel surcharge on every ride and pass 100% of the pain to the consumer.
But Grab didn't do that.
No, management actively stepped in. They deployed targeted financial support to protect driver earnings while simultaneously making a deliberate operational push to maintain the affordability of rides for the consumers.
So they just ate the cost.
They absorbed a portion of that macro shock, rather than hiking core commissions or permanently alienating their user base. They are playing a long-term game of habit formation, not a short-term game of price gouging.
Which naturally brings us to the concept of the moat. We've established they have this massive, highly engaged user base locked in a flywheel, but they don't have infinite pricing power. So how deep is the protective trench around this business?
That's the billion-dollar question.
The research report gives Grab's moat a rating of narrow but widening. And I have to admit, I struggle with that classification. How can a moat be narrow if you are the dominant player in 8 countries?
Well, in traditional equity analysis, a wide moat implies near invincibility. Think of a pharmaceutical company holding a 20-year patent on a life-saving drug, or a railroad company owning the only physical tracks into a major port.
Okay, so structural stuff.
Exactly. Structural, insurmountable barriers.
Yeah.
Grab doesn't have that. What they have are network effects. More drivers on the road means faster pickup times for riders. Faster pickup times attract more riders, which in turn attracts more drivers seeking fares. It's a powerful loop, but it is not impenetrable.
Right, because at the end of the day, a rider sitting in Jakarta can open Grab, see a ride costs 50,000 rupiah, and then open a competing app like GoTo in 2 seconds to see if it's 40,000.
It takes zero effort.
The switching cost is basically just the movement of a thumb. If the friction is purely behavioral, is that a real moat?
You'd think it wouldn't be. But the numbers tell a slightly different story. Chief Financial Officer Peter Oey has addressed this dynamic extensively. The stickiness isn't just about laziness. It's about the economic architecture of the multi-service bundle. Specifically, it's layered with subscriptions. Grab pushes a program called Grab Unlimited.
Which is basically their version of Amazon Prime.
Precisely. Once a user subscribes to Grab Unlimited, they unlock tiered discounts across food delivery, ride-hailing, and digital wallet benefits. Once that sunk cost of the subscription is paid, the user's default behavioral habit completely shifts.
Ah, I get it. Because you've already paid for the privilege of the discount.
Right. You might briefly check a competitor for a single isolated ride, but you aren't going to migrate your entire daily ecosystem of food, payments, and transit if you're already paying a subscription that makes Grab the trench. Grab the cheapest option in the aggregate.
Which makes sense.
That's why the rating is widening. Every new service they successfully graft onto that bundle digs the trench a little deeper.
The bundle is definitely strong. But honestly, the most compelling argument for their moat in this entire report sits under the intangible assets section. It highlights their hyper-local infrastructure fit.
Yeah, this is a crucial part of their history.
Because to really understand Grab's moat, you can't just look at who they are competing with today. You have to look at the monster they already defeated. We have to talk about Uber.
It remains one of the most vital case studies in modern platform economics, for sure. In the mid-2010s, Uber entered Southeast Asia with an effectively unlimited war chest of Silicon Valley venture capital.
They were basically unstoppable back then.
They had world-class engineering, global brand recognition, and ruthless execution tactics. And Grab, which was just a regional upstart, structurally dismantled them and eventually absorbed their Southeast Asian operations.
The obvious question is, how? How do you beat an opponent who can afford to lose billions of dollars outspending you?
By understanding that software doesn't solve physical realities.
Elaborate on that.
So Uber's entire, elegant, frictionless model was built on the assumption of widespread credit card penetration. The magic of Uber in San Francisco was that you got in the car, you got out, and the transaction happened invisibly in the cloud.
Seamless.
Right. But Grab looked at Southeast Asia and recognized a fundamental truth. A massive portion of the population was unbanked. Credit card penetration was incredibly low. So Grab did something that broke the elegant software model. They enabled physical cash payments.
Okay, let's pause and actually walk through the mechanics of that because it sounds like a simple feature update, but operationally, it is a nightmare.
It's a massive headache.
If I take a ride and hand the driver physical cash, Grab hasn't collected its 20% commission, the driver just has a pocket full of bills. How does the platform get its cut?
That exact logistical nightmare is why Uber resisted doing it for so long. To make cash work, Grab had to build an entirely separate, hyper-local financial infrastructure.
What did that look like?
They required drivers to maintain a prepaid digital wallet with the company. When a driver accepts a cash fare, Grab instantly deducts its 20% commission from the driver's digital wallet.
Which means the driver has to constantly top up that digital wallet with real money?
Yes, and since the drivers were often unbanked themselves, Grab couldn't just ask for a bank transfer.
Oh, wow.
They had to build partnerships with local convenience stores, pawn shops, and neighborhood kiosks across thousands of cities, allowing drivers to walk in, hand over physical cash to a clerk, and have it instantly credited to their Grab driver app.
So while Uber was sitting in California writing cleaner code, Grab was out in the humidity of Manila and Jakarta, negotiating with mom-and-pop mini-marts to act as physical cash deposit nodes.
Precisely. They built dense, localized networks block by block. They integrated with local motorcycle taxi syndicates in Indonesia, the Ojek drivers. They adapted to the chaotic, on-the-ground realities of regions that Western tech companies viewed as mere data points.
Which is incredible.
It is. What this proves to an investor today is that Grab's ultimate moat isn't its source code. It's the incredibly messy, unglamorous, hyper-local infrastructure they spent a decade building. You can't just copy and paste that kind of trust and physical integration.
Which perfectly transitions us to the next massive pivot. They survived the capital wars, they beat Uber, they built the hyper-local moat. But for the last decade, the playbook for these gig economy companies was simple. Raise billions in venture capital, heavily subsidize rides to acquire users, and pray you figure out how to make a profit before the music stops.
The standard Silicon Valley model, yeah.
But Grab has reached the end of that playbook. The subsidies are drying up, so where does the new growth come from?
Management is remarkably transparent about this. The core mobility and food delivery businesses, the things that made the brand famous, are foundational, but they are not the primary margin drivers of the future.
Right.
The future of Grab is micro-lending.
This is such a radical identity shift. The app I used to order a chicken sandwich is transforming into a bank.
It is the ultimate realization of the super app model. The Q1 2026 data in the report is striking. We noted earlier that financial services revenue grew 43% year over year.
Yeah.
But the underlying engine of that growth is their gross loan portfolio, which exploded by 130%. They aren't just processing payments anymore. They are aggressively expanding credit.
Let's break down why they have such a massive advantage here. Think about a traditional bank. If a small street food vendor, let's say a local nasi goreng stall, walks into a traditional bank in Jakarta and asks for a loan to buy a second wok and hire an assistant.
The bank is going to ask for audited financial statements, tax returns, collateral.
Exactly, and the vendor probably has none of that. To the traditional banking system, that vendor is a ghost. They are ununderwritable.
But to Grab, that vendor is a highly detailed, deeply verified data profile.
They see everything.
Grab knows exactly how many plates of nasi goreng that stall has sold every single day for the last 3 years. They know the vendor's peak hours, their customer retention rate, their inventory turnover, and their exact daily cash flow.
Because Grab has been processing all those transactions.
Exactly. They have a proprietary, real-time ledger of the merchant's economic health. Therefore, Grab can instantly approve a microloan through its digital banking arms like GXS Bank in Singapore, GX Bank in Malaysia, or Superbank in Indonesia, with a fraction of the default risk a traditional bank would face.
That's amazing.
And they do the exact same thing for their drivers, offering vehicle financing that is paid back automatically through daily fare deductions.
It's brilliant because it solves the margin problem. Moving physical humans and hot food through chaotic traffic is a notoriously low-margin, high-friction business. But extending credit digitally based on proprietary algorithms, that is a high-margin software business.
And that transition from physical logistics to digital finance is how they plan to achieve long-term profitability. But internal growth isn't their only lever.
Right, there's the M&A side.
Yeah, the report also details a major move on the geographic front. Grab recently initiated a roughly $600 million acquisition of Delivery Hero's foodpanda operations in Taiwan.
This is a massive plot twist. For its entire existence, Grab's defining narrative has been, we are the champions of Southeast Asia. But Taiwan is decidedly not Southeast Asia. It's a highly developed market of 23 million people. It feels like they are stepping out of their heavily fortified castle for the first time.
It's a critical proof of concept. The acquisition targets full migration by early 2027 and is expected to be accretive to their 2026 revenue guidance.
What's the main takeaway for investors here?
The strategic question is whether the Grab playbook, the flywheel, the merchant integrations, the localized operational efficiency, can successfully transplant into a brand new, culturally distinct market. If they can execute in Taiwan, it suddenly opens up the map for much broader regional ambitions.
But the research report is very careful to balance this expansion hype with some stark operational realities back home. Let's look at the weaknesses in growth section, because there's a massive regulatory roadblock sitting right in the middle of their biggest market, Indonesia.
The regulatory environment is often the silent killer of platform economics. Effective June 2026, the Indonesian Manpower Ministry implemented a strict 8% cap on the commission fees that ride-hailing platforms can charge.
An 8% hard cap. That is devastating. When you look at platforms in the U.S., take rates can routinely float between 20 and 30%.
Easily.
So a legal ceiling of 8% means the government is essentially capping your gross margin.
It fundamentally alters the growth math. If you are an executive at Grab and you miss your quarterly revenue target, your traditional move would be to tweak the algorithm and increase the take rate by 1 or 2 percentage points.
Right, just squeeze a little more out of each ride.
But in Indonesia, that lever has been legally welded shut. You cannot price your way out of a revenue miss.
Which means the only way to grow in Indonesia is through pure raw volume. You have to facilitate millions of more rides or dramatically scale up the high-margin advertising and micro-lending businesses we just talked about to offset the constrained mobility margins.
That is exactly the dynamic. And it provides a perfect bridge to evaluating the company's financial health.
Let's do it.
We know they have to pivot to self-funding. We know they're expanding to Taiwan. And we know they're building a massive loan book. The question is, does the actual accounting support this narrative? Or is this just another tech company burning venture capital to maintain an illusion of growth?
Let's dive into the metrics. The equity research framework classifies Grab as having entered phase 3 of its corporate lifecycle, which they title self-funding growth. The overarching scorecard here is highly positive. 4 out of 5 key indicators are glowing green.
The defining characteristic of Phase 3 is that the company is no longer reliant on external capital markets, meaning no new stock issuances or massive debt offerings to keep the lights on and fund daily operations.
And the top-line numbers support that scale. They are showing a 3-year revenue compound annual growth rate, or CAGR, of roughly 33%.
Which is very strong.
Sustaining a 33% growth rate when your baseline is already over $3 billion is incredibly difficult. It proves the flywheel is still pulling in a new velocity.
But top-line revenue is vanity. Bottom-line margins are sanity. The most critical metric for a Phase 3 transition is operating profitability. In Q1 2025, Grab's operating margin was negative 2.7%. By Q1 2026, that had flipped to a positive 2.3%.
Meaning the core business of moving things and processing payments actually generates a profit on its own merits before accounting gymnastics.
Yes, and CFO Peter Oey makes a point to emphasize that this wasn't an accounting fluke or a one-off lucky quarter.
What drove it then?
It is the culmination of a deliberate, agonizing, multi-year strategy executed between 2023 and 2025. They aggressively slashed user incentives. They stopped trying to buy the loyalty of transient users who only opened the app when they had a promo code.
Oh, that makes sense. Focus on the core users.
Exactly. They focused entirely on the operational efficiency of the core, sticky users who utilize the multi-service bundle.
Okay, so revenue is growing and operating margins are positive. But here is where we need to get into the weeds of the cash flow statement, cause the report flags a discrepancy that is going to confuse a lot of casual investors.
It trips a lot of people up.
The report notes that adjusted free cash flow flipped positive, hitting $98 million. That sounds great. But if you look at the raw, unadjusted operating cash flow, it was negative $59 million.
Right.
How does a company claim to be self-funding and cash flow positive when the actual cash flow from operations is negative $59 million? Are they hiding something in the adjustments?
It is a vital question, and it is the exact reason why analyzing a super app requires a different toolkit than analyzing a standard software company. It isn't nefarious accounting.
So what is it?
It is a structural byproduct of the fintech pivot we discussed earlier.
Yeah.
You have to understand how loan originations impact a cash flow statement.
Walk us through the mechanics of that.
When Grab's digital bank approves a $1,000 loan for a merchant to upgrade their kitchen, Grab literally wires $1,000 of cash out the door. On the cash flow statement, that shows up as a massive cash outflow today.
Mix.
Over the next year, that merchant will pay back the principal plus interest, which will eventually generate positive cash flow. But in the immediate term, rapid growth in a lending portfolio destroys your operating cash flow.
Ah, I see. Because the loan portfolio grew by 130%, they are aggressively pushing cash out the door to fund those loans. So the core business, the rides, the deliveries, the ads, is generating positive cash. But the banking arm is consuming cash to build its loan book.
Precisely. The adjusted free cash flow metric strips out those loan originations to show you the health of the underlying operations. So the negative $59 million isn't a sign that the mobility business is failing. It is a sign that the banking business is successfully deploying capital.
But there's a risk there, right?
Oh, absolutely.
Yeah.
As an investor, this becomes your primary monitoring point. You have to watch the non-performing loan ratios carefully. If those loans go bad and the merchants default, that negative cash flow becomes a permanent loss.
It's a high-wire act. They are balancing the cash generated from a low-margin physical business to fund a high-margin, high-risk financial business.
Exactly.
Which brings us to the threats that could knock them off that wire. Let's look at execution risk analysis. The report grades the overall risk as medium, but within that, the outside forces category is flashing red. It's rated as high risk and worsening.
The existential threats to Grab aren't technological. The app isn't going to suddenly stop working. The threats are entirely regulatory and competitive. We have to view that 8% Indonesian commission cap through the lens of their competitive reality.
Right, because if I'm a normal business and the government caps my primary revenue stream, my instinct is to invent a new fee. Let's charge the consumer a platform technology fee or a booking convenience fee to make up the difference. Why doesn't Grab just pass the regulatory cost on to the rider?
Because the market structure won't allow it. Grab operates in a brutal duopoly in Indonesia with a massive localized rival called GoTo.
The other giant in the region.
Yep. The switching costs for consumers, while rising due to the bundle, are still ultimately tethered to price elasticity. If Grab tries to circumvent the government cap by slapping a massive booking fee on the consumer, that consumer will simply open the GoTo app.
The thumb swipe.
Exactly. Grab is trapped in a vice. The government is pushing down on their margins from the top, and GoTo is blocking them from passing those costs onto the consumer at the bottom.
It's a Mexican standoff. And historically, the capitalist resolution to a duopoly price war is consolidation. You just buy your rival, end the price war, and establish a monopoly.
Which is exactly why the financial markets have been swirling with rumors of a Grab and GoTo merger for years. It is the logical conclusion to the margin squeeze.
Is it going to happen?
Well, even if both management teams secretly wanted it, there is an immense structural roadblock. Indonesia's competition regulator, known as the KPPU, operates under strict 1999 antitrust laws. They have already signaled publicly that a tie-up of that magnitude would likely violate anti-monopoly regulations and be heavily scrutinized, if not outright blocked.
So they are caught in a regulatory cage match. How does a company mitigate that level of localized pressure?
By utilizing the ultimate corporate shield liquidity and geographic diversification.
Show me the money.
Exactly. The report breaks down their defensive posture. Grab is sitting on $6.9 billion in gross liquidity and a net cash pile of $5.0 billion.
$5 billion in pure net cash. That is an absurd amount of ammunition.
It allows them to absorb the margin compression in Indonesia indefinitely. They can outlast almost any localized price war. Furthermore, they are not solely reliant on Jakarta. Singapore, Indonesia, and Malaysia combined make up about 70% of their revenue.
Oh, that's a good spread.
Yeah. If the Indonesian regulatory environment becomes completely toxic, Grab still has highly profitable, mature operations in Singapore and Malaysia to keep the overall enterprise afloat. They are too diversified for a single market failure to sink the ship.
Speaking of that balance sheet and that $5 billion cash pile, let's pivot to the actual accounting health check, because this is where the story gets really complex. The analysts who prepared this report ran a diagnostic on Grab's assets and liabilities, and on the surface, it looks incredibly disciplined.
It is a remarkably clean balance sheet for a tech company of this scale. Let's look at the specific indicators. First, goodwill is only about 9% of total assets.
Let's explain why that matters for the listener. Goodwill is an intangible asset that gets recorded when a company buys another company for more than its actual book value. It's often used as an accounting dumping ground to inflate a company's total assets.
Exactly. When you see a tech company where goodwill makes up 40 or 50% of their assets, it usually means they overpaid for acquisitions during a boom market.
And a write-down is coming.
Yeah, and they are eventually going to have to take a massive write-down that will destroy their equity. Grab keeping goodwill at 9% shows immense discipline. Second, their receivables are scaling proportionally with their revenue.
Which means?
This confirms that the revenue they are reporting is actually turning into cash, not just sitting as uncollected IOUs. There is no preferred stock sitting there waiting to dilute the common shareholders. And they have $2.9 billion in raw cash and equivalents, which easily covers their $1.9 billion in total loans and borrowings.
It sounds perfect. But there is a number on this balance sheet that is so large it almost looks like a typo. It is a glaring red flag.
I know exactly what you're looking at.
The accumulated deficit, the total losses accumulated over the lifespan of the company, sits at a staggering negative $17.335 billion. Negative $17 billion.
That's a huge number.
When I see that, my brain immediately thinks this company is a black hole. To me, it's like looking at an elite marathon runner who just won a race, but when they take off their shirt, they have a massive, jagged surgical scar from open heart surgery.
I think the surgical scar is the perfect way to conceptualize it. That $17.3 billion deficit is terrifying if you don't understand its origin, but it is fundamentally a legacy number. It is the literal financial scar tissue of the capital wars of the 2010s.
When they were fighting Uber and GoTo.
Yes. To win, Southeast Asia, Grab, Uber, and GoTo engaged in a decade-long war of attrition. They subsidized billions of dollars in rides, essentially paying consumers to form the habit of using ride-hailing apps.
Right.
They were subsidizing the creation of an entirely new market behavior. All of those subsidies, all of that marketing, resulted in massive annual losses that accumulated year after year on the balance sheet.
No, so that negative $17 billion isn't money they currently owe to the bank.
No. It represents equity capital that was raised from venture capitalists and subsequently burned to build the moat. It is a sunk cost.
Okay, that changes things.
It is a historical marker showing exactly how expensive it was to build a super app from scratch. But because Grab now has $6.5 billion in positive total equity and is posting positive operating margins, that wound is entirely closed. They are no longer bleeding out.
Okay, so if the bleeding has stopped, the wound is closed, and the company is entering a phase of self-funding growth.
Yeah.
How on earth do you value it? Because if you open up a standard Finance 101 textbook, the first thing it tells you to look at is the PE ratio, the price to earnings multiple.
And this report explicitly warns investors that attempting to value Grab using a standard PE ratio or price to free cash flow right now is a trap. You have to ignore those traditional metrics.
But earnings are the ultimate truth of a business. Why would we ignore them?
Because in this specific transitional phase, the GAAP net income, the official earnings number, is heavily distorted by non-cash accounting artifacts. The most prominent example is Grab's $1.5 billion in convertible notes.
Let's unpack how those notes warp the math. A convertible note is basically debt that can transform into equity, into stock at a later date.
Exactly. And because the value of that debt is tied to Grab's stock price, accounting rules require Grab to constantly adjust the fair value of those notes on their balance sheet.
Meaning what exactly?
If Grab's stock price goes up, the theoretical value of those notes goes up, meaning Grab's liability increases. To balance the books, Grab has to record a massive expense on their income statement.
Even though they didn't actually write a check or lose a single dollar of real cash, it's purely paper math?
It is entirely paper math, but that paper expense destroys their GAAP net income. So if you look at their PE ratio, it looks abysmal, completely obscuring the fact that the underlying core operations actually turned a profit.
Oh, wow.
And as we detailed earlier, the rapid growth of the loan book distorts the raw free cash flow. If you try to value Grab on PE or raw FCF today, you are looking through a funhouse mirror.
So if the traditional tools are broken, what does the analyst recommend? How do we determine if the stock is cheap or expensive?
The report relies on two alternative metrics, price to sales, or PS, and price to gross profit. At the time of this research, Grab's market cap was hovering around $15.9 billion. Against their trailing 12-month revenue, that yields a price to sales multiple of roughly 4.5x.
For context, is 4.5x considered steep?
For a mature, slow-growing industrial company, yes. But for a tech platform that is still compounding top-line revenue at 24 to 33% year over year, 4.5x is considered quite reasonable. You're paying a fair premium for that sustained top-line velocity.
Right.
But the more illuminating metric is the secondary one, price to gross profit, which sits at around 10.3x.
Why focus on gross profit?
Because it proves the revenue isn't empty calories. It confirms that their margin structure is stabilizing. Their gross margin has climbed to around 43%.
Which is healthy.
Very healthy. The takeaway here is that when a company transitions into phase 3, you value their ability to convert massive top-line scale into stable gross margins, particularly as they accelerate the mix of high-margin segments like advertising and fintech. You are valuing the trajectory of the machine, not the distorted exhaust it happens to be producing this quarter.
But this brings us to a massive contradiction. We move to the analysis of price and sentiment. We just laid out a fundamentally bullish case. The metrics are stabilizing, operating margins are positive, they have 50 million monthly users, and they have $5 billion in net cash. Logically, the stock should be on an absolute tear.
It is the rational expectation.
But the reality check provided in the report is brutal. The stock is actually down roughly 20% over the trailing 12 months.
Yeah, tough.
It has been languishing near its 52-week lows, bouncing between $3.18 and $6.62. And perhaps most agonizing for long-term holders, Grab has drastically underperformed the broader market, lagging the S&P 500 by about 40 percentage points over that period. The entire market experienced a massive rally, and Grab went backward.
It creates a fascinating scenario that we can call the Wall Street paradox. Because while the actual public market of buyers and sellers is rejecting the stock, professional analyst sentiment is overwhelmingly bullish.
Explain that.
Out of the major institutional analysts covering Grab, an incredible 27 of them rated a strong buy. Their consensus 12-month price target averages around $5.97.
At the stock sitting around $3.88, that target implies a massive upside of over 50%. So the people who build discounted cash flow models for a living think the company is deeply undervalued, but retail and institutional investors refuse to bid it up. Why is there such a massive disconnect?
It is a confluence of market psychology, macroeconomic timing, and exhaustion. First, there's profound weariness around the go-to merger rumors.
Ah, the boy who cried wolf.
Exactly. For years, every time a credible rumor leaks, algorithmic traders spike the stock. Days later, when management issues a denial or the antitrust reality set in, the stock crashes back down. Genuine investors are tired of the volatility and have stepped away.
Wait.
Second, the Indonesian regulatory overhang, that 8% commission cap, creates an unquantifiable ceiling on their near-term profitability, and markets abhor uncertainty.
And there's a macro factor at play too, right? The massive gravity of the U.S. tech sector.
Exactly. Over the last year, we have seen a massive rotation of capital. Investors are pulling funds out of complex, emerging market growth stories with regulatory headaches, and indiscriminately parking that capital into perceived AI safe havens in the United States. The semiconductor manufacturers, the foundational models.
So Grab is just getting overlooked.
Grab is a victim of that macro capital flight.
There is also a bit of boardroom trivia noted in the report that I find deeply ironic. Dara Khosrowshahi, the CEO of Uber, officially stepped down from Grab's board of directors in July 2026. Now, Uber kept its massive economic stake in the company, but Dara left the room.
It is a notable shift in corporate governance.
It's just wild when you think about the history we discussed earlier. Grab forged its entire identity by defeating Dara's company in Southeast Asia. They forced Uber to surrender, took over their operations in exchange for equity, gave Dara a board seat, and now he's out. It perfectly encapsulates how fiercely intertwined and messy the global tech landscape is.
But your mention of AI safe havens provides the perfect transition to the existential horizon of this company.
Let's go there.
Let's pull back from the day-to-day stock price volatility and look 5 or 10 years down the road. Every single board of directors on the planet is currently terrified of AI disrupting their core business model. How does a company that fundamentally relies on human beings driving cars and carrying hot food survive the impending era of autonomous vehicles and artificial general intelligence?
Right. If Waymo or Tesla can drop a fleet of robotaxis into Singapore that operate 24/7 without needing bathroom breaks, doesn't Grab's massive network of human drivers become completely obsolete overnight?
The equity research analysts actually grade Grab as anti-fragile to AI disruption, assigning it medium confidence.
Okay, why?
They construct this defense using a couple of distinct frameworks. The first is the nature of their monetization. Grab's revenue is fundamentally usage-based, not seat-based software.
Explain the difference.
If you build a company that sells copywriting software and an AI comes along that can write better copy for free, your subscription revenue goes to zero instantly. That is seat-based software risk.
Which is terrifying.
Right. But Grab operates a transactional toll booth on physical economic activity. Whether a human taps the app to order the food or a personal AI assistant automatically orders groceries based on your fridge inventory, Grab still collects its commission on the gross merchandise value.
So they don't care who orders it.
Right. Whether a human is driving the car or a robot is driving the car, the transaction still has to be facilitated.
And the second framework is the friction of the physical world itself.
Yes. You cannot algorithmically code away the physical constraints of reality. You still need physical warehouses to store the groceries. You still need physical vehicles navigating degraded infrastructure. And you still need the actual physical transfer of a hot meal from a restaurant kitchen to a fifth-floor apartment. The physical world acts as a massive anchor against pure software disruption.
But let's go back to the autonomous vehicle threat. Say an American AV company successfully scales a fleet of robotaxis. Why wouldn't they just bypass Grab entirely and launch their own proprietary ride-hailing app? They have the cars. Why do they need Grab?
Because they don't have the map.
The map.
Yes, and this is where management's long-term strategy is truly brilliant. According to CFO Peter Oey, Grab is not sitting passively waiting for AVs to arrive and crush them. They have been actively building a proprietary, impenetrable data moat called Grab Maps. They have leveraged 14-plus years of hyperlocal Southeast Asian transaction data, routing data, and fleet management experience.
But wait, why wouldn't an AV company just license Google Maps or Apple Maps? How is Grab Maps any different?
Google Maps is an incredible tool for navigating a well-paved, regulated highway system in California. But Google Maps does not understand the chaotic, unmapped reality of Southeast Asia. It doesn't know the intricacies of a 2-meter-wide alleyway in Jakarta. It doesn't know where the specific unmarked service entrance to a labyrinthine megamall in Manila is located. It doesn't know which roads flood during a monsoon and where it is safe to pull over a motorbike.
And Grab knows all of this.
Grab has mapped this reality down to the square meter by crowdsourcing billions of GPS pings from their drivers' smartphones over a decade. They have a living, breathing, topographical map of Southeast Asian commerce.
The implications of that are staggering. When the Western autonomous vehicle companies finally try to deploy in Southeast Asia, their incredibly sophisticated cars won't know how to navigate the actual streets. They will be blind to the local chaos. To function at all, they will be forced to license Grab's proprietary mapping data and plug their fleets directly into Grab's existing demand network. Grab isn't going to be replaced by the robots. They're positioning themselves to be the operating system for the robots.
Exactly. They are transforming their historical data into the proprietary toll road that the autonomous vehicles will be forced to drive on. That's the core thesis behind their anti-fragile rating.
Okay, I see the long-term vision. It's compelling. But I have to push back one final time. The AV defense makes sense, but is there anywhere in the business today where AI could actually cause an existential crisis? Where is the real vulnerability?
The report flags one critical area, and it is the exact segment driving all their future growth fintech.
Oh, right.
The true vulnerability is hallucination risk. We have to go back to that digital banking loan book, which we noted grew 130% year over year to $1.4 billion. Grab is heavily utilizing AI and algorithmic alternative credit data to instantly underwrite those loans.
And if the algorithm makes a mistake...
If the AI hallucinates, or if the core algorithm has a fundamental undetected flaw in how it assesses the default risk of a merchant in Thailand or a driver in Malaysia, the consequences are immediate. Grab isn't just serving up a bad movie recommendation or writing a weird email. They're handing out real, unrecoverable cash.
That's terrifying.
A catastrophic algorithmic failure in their credit underwriting models could cause massive, real-world financial losses almost instantly, tearing a hole right through that $5 billion cash pile. That is the critical failure point that investors must monitor obsessively.
That is an incredibly sobering reality check. We have covered a monumental amount of ground today. We've dissected the safety-first origins, the hyper-local cash moat, the $17 billion balance sheet scar, the fintech pivot, and the AI mapping defense. Let's bring this deep dive in for a landing. What is the ultimate investment takeaway from all this research?
The overarching conclusion of the equity research is that Grab is best suited for capital growth investors. This is a classic Phase 3 company. They are taking the cash generated by their mature, stabilized operations and aggressively reinvesting it into scaling their digital banking footprint and expanding their geographic borders, as we saw with Taiwan.
Right.
They did authorize a $500 million share buyback recently, which is a nod of confidence to shareholders, but primarily, this is a story of a management team attempting to apply their old, highly successful, hyper-local playbook to massive new frontiers.
And to recap the tension we've explored, the bull case is undeniable. They have finally achieved operating profitability. They command 27 strong buy ratings from institutional analysts, and their fintech margins are poised for explosive growth as they continue to underwrite the massive unbanked population of the region.
But there's always a bear case.
The bear case is equally potent. The stock has drastically underperformed the S&P 500. They are chained down by a strict 8% regulatory commission cap in their largest market, and antitrust regulators are actively blocking their easiest path to duopoly consolidation.
Ultimately, an investment in Grab is a bet on execution. It comes down to whether you believe this specific management team can execute their localized trench warfare playbook against government regulators and go to just as effectively as they executed against Uber a decade ago.
It is one of the most complex, fascinating corporate narratives in the public markets today. And as we wrap up, I want to leave you, the listener, with a final provocative thought to mull over. Something that synthesizes everything we've unpacked today into a slightly different perspective.
Lay it on us.
Consider this trajectory. If Grab successfully locks down the proprietary hyperlocal mapping data for the physical streets of 8 different countries, rendering themselves absolutely indispensable to the future of autonomous transportation. And simultaneously, they utilize their data advantage to become the primary microlender, credit underwriter, and digital bank for the massive underbanked population living in those exact same countries.
Where are you going with this?
Are we still looking at a traditional technology company? Or are we witnessing the slow, deliberate birth of a privately owned digital public utility for the entirety of Southeast Asia? Think about the implications of that the next time you open an app to order dinner.
It changes the entire scale of what you are participating in.
It absolutely does. Thank you for joining us on this deep dive. Keep questioning the information around you, keep looking for the underlying mechanics behind the numbers, and we will catch you on the next one.